Well, good morning, everyone. It is 8:30 and I'm going to call the Finance and Economic Development Committee meeting to order. We have a published agenda and I will move that we accept the agenda as
Mr. Mayor.
Yep.
Mr. Mayor, we have one amendment to the agenda.
Okay.
We'd like to add to our investment portfolio. We put that at the end.
Sure. Okay. With that, can I get a motion to approve? I move that we approve the amended agenda.
Second.
It's been moved and second. Any discussion? All in favor, say aye.
Aye.
Any opposed? Motion carries. We have an amended agenda. First up on our amended agenda is our reserve designation ordinance. Troy.
Great. Thank you, Mr. Mayor. Good morning, everyone. This has kind of been an annual process for us ever since 2009, when the Governmental Accounting Standards Board issued statement number 54. It's really a reporting issue in terms of how we report reserves. Real briefly, I mean, the committee's been through this and the entire council's been through this several times, but for the sake of the audience, there's really 5 designations for reserves. There's non-spendable, which is basically as it's described. It's the reserves are in a form of which cannot be spent. So like a receivable or an inventory. We have restricted reserves, which is these are funds that are restricted from a specific purpose, most commonly by state law or constitutional provision. There's committed reserves, and these are the reserves that are restricted by the highest decision-making level of the government, which is you, the city council. There are assigned reserves. These are reserves that are basically designated as intended to be spent by a specific purpose. And historically, the council has authorized the finance director and the city manager to assign reserves. And then we have unassigned, which is basically everything else. There's no restrictions whatsoever on these funds. We will look at the details. I'll share a screen here in a moment, but we do plan to have a full city council discussion on reserves on December 8th, and we hope that the council will adopt the annual ordinance on the 15th of December. We would be asking the council for the same authority in terms of the assigned reserves to allow the city manager and finance director to designate as such. So I will share a screen and show you the reserves. You did see this basically the same table back at the workshop on the budget back in October. Really what we want, I'll kind of run through these pretty quickly because there's not a lot of changes, but we really want the conversation here this morning to focus on the funding of the police station. And that's really been the focus of the council, and really want to get a sense of your direction and your comfort level with what we have proposed. So what you see on screen, these first funds are the funds that make up the general fund. Like I said, I'll go through these pretty quickly, just highlight the the designations we're going to ask the council to change. For now, we'll skip over the gateway development. That's going to be a key component in the conversation for the police station. I do want to remind the committee that last year the council asked that staff look at future affordable housing as a priority in terms of identifying funds. We could certainly discuss that a little bit more here this morning and with the full council. We do want the council to change this $399,000 reserve from assigned to committed in December, and this will give us a full $2 million for police succession planning. At the end of 2021, we did assign $5 million for the construction and implementation of phase 1A for Great Cuyo Park. So currently that's assigned. We'd like the council to commit those funds. Very similar, we identified $250,000 for energy conservation projects, the implementation of the carbon reduction plan. This also was identified by the council as a priority for staff to look at in terms of suggesting reserves. Criminal justice, no change. I will point out that we did spend we didn't spend, we transferred $1.6 million from this fund into the building fund for the design and the land acquisition for the police station. No changes suggested for community buildings. Same with the regional athletic complex, the RAC, no change suggested. Street fund as well, no changes suggested. Looking at our capital equipment fund, just a small change. We would like the council to commit just over $18,000 to expand our financial software system to include a purchasing credit card module to help staff administer that program.
So I also see security cameras in parks. Where are we at in making sure we have cameras in all of our parks?
We do have monies in the, I believe it's next year. So we have a 2-year phased project that will put cameras, expand cameras in the park systems. I think we're looking at Rainier Vista first, and as well as the depot area. We have a separate project that's happening as we speak. Actually, it may be completed. We expanded the camera system at the RAC. So there are several more cameras up and running in the RAC currently. So within a 2-year period, we should have all the major parks with camera systems.
Great, thank you.
Looking at some of our more miscellaneous funds, we'll come back to the Arterial Street Fund. Again, this will be a critical component of the conversation for the police station. Transportation Improvement Fund, as you've seen in the proposed budget, we have a much larger program slated for next year, $7.5 million. So we'll be using some of this $5.3 million reserve. Lodging tax, no change. Chicks Lake Management, no change. Building Improvement Fund, no change as well. Parks and Open Space, no change. We do want to ask the council to consider committing another $1 million within the RAC capital fund, really to look at, to give us more time in terms of that long-term financial planning. I mean, this is a park that, I mean, it's a community park, as we've discussed in the past, so we really need to have that conversation about what we're going to do in terms of support of that operations from the general fund. The debt fund, no change. Within our equipment rental fund, this is our fleet fund. Staff has identified $2.5 million and assigned for green fleet conversion. As you know, Washington State has a mandate to convert vehicles to electric where possible by 2035. We are actually going to get started here this year, but we did identify $2.5 million for that purpose. And then information management systems, our computers, our networks, no change there as well. So going back to are there any questions on what I ran through very quickly before we focus on the police station conversation?
No, this wasn't included in our packet though. Can you send this out to us?
I sure can. So we did have an initial conversation about the funding of the police station. The conversation has really focused on a $40 million total cost for construction. As you know, we do have separate funds that we've already committed and identified for land acquisition. So, strictly for the building purpose. One of the considerations is to use the Gateway development investment of $8 million, which is currently committed, to shift those monies to the construction of the police station. We've also had conversations about using the $7 million of ARPA funds. I know the council will have, a much broader discussion about that in terms of some of the regional commitments as well as the police station. The other conversation we've had is in our arterial street funds. So we have a cash balance at the end of 2021 of just under $39 million. The vast majority of this $39 million is real estate excise tax. We just did a really in-depth analysis of the last 20, almost 30 years of expenditures and revenue within this fund. I do want to recognize the work of Alex and Chelsea in the finance department, as well as some help from Martin over there in transportation. We literally looked at every single expenditure and revenue coming in for 30 years to really get a strong handle on what those reserves are. We're still putting the final touches on that, but like I said, I have a strong confidence level that the majority of this balance can be considered real estate excise tax. And why that's important is there is a wide variety of authorized uses of real estate excise tax. It's not just restricted to transportation projects. You could even use the monies for utilities, parks, obviously just kind of general capital for the city. So this is certainly a consideration, I think, for the council in terms of funding the construction of the police station. So we have talked about, a $17 or $18 million number in terms of drawing down this real estate excise tax reserve. So that would be a combination of about $25 million in reserves when you add in the gateway.
Yeah.
And then another 7 million from the ARPA dollars. So, we've got quite a commitment in terms of getting us to our, probably $15 million debt commitment for that. So that's kind of the tentative plan. Really want to turn it back to you, to the committee, to give us any direction or thoughts on that, just to see if we're going in the right direction as we head into the full discussion. So
do we have to prove that 25 million or 15, whatever we're going to take from the street funds are REIT dollars? We have to show our math on that?
Not necessarily for this purpose. I mean, it's something we track and we do in terms of tracking those special revenues. That kind of goes into the restricted discussion that we had earlier. But yeah, I mean, we will finalize those numbers before we have to make those final commitments. But we did take a really hard look at the other sources of revenue within that fund, gas tax primarily. But yeah, we're feeling very confident that monies are available for you.
Well, and the only other thing I'm looking at when I see these dollars is what we have 52 million cash on hand. Is that correct?
Total general fund. So the council could certainly decide to reprioritize any one of those funds. I mean, that's really at your discretion.
Yeah. So, I mean, I guess what I'm saying is we obviously are sitting on a lot of reserves. So however we get to that number, I think is really more left up to you, Troy, right? Like we're going to follow your lead on where we think we should bring those dollars from. But I feel pretty confident that we're sitting on enough reserves that we should be able to make this math work one way or the other. And the other thing what we have to think about is, how much of this really going to cost in the end. We have an estimate, and I'll be surprised if it comes in under what is currently being bid at. There's so many unknowns out there that we should probably build in a contingency as we're talking about these reserves. And I'd rather have, another 5 million, 10 million that we know we can count on, from the get-go. Although I know it's a fine line there though, because we don't want to then say, oh, we're automatically going to spend that money and don't worry about, cost overruns. But yeah, on the same hand, we better be prepared if it does come in more expensive than what we think it's going to be. So, but either way, if it's from the arterial street fund, if it's from our other sources, I think it's just a math question that I think you're probably the best prepared to give to us a recommendation. And if you think it's arterial street fund and those two other funds, then you have my support.
Well, Mayor, also, I guess for the committee to consider too, we haven't done the year-end closing for 2022 yet. So there should be, assumption there'll be a surplus at the end of the year for that also. And this is a 2-year project too. So if we have to make it that additional 10 million, because you saw that estimate, it's a $49 to $52 million. So hopefully we can make it up in 2 years, that gap, even though we've identified about 25 million of reserves so far.
Yeah. Malcolm, do you have anything you want to add?
Yeah, so the ATS amount, it looks like it grows what, like 3 to 5% a year. Is that about right? The fund that you just had on the screen that had the $38 million in it.
Well, it really depends on the level of capital improvement program. But yeah, it's been growing at a pretty steady rate. Probably even higher than that 3 to 5%.
And I'm just kind of wondering, over a period of time, what would it, how much will it replenish in a 5-year period or a 10-year period?
Yeah, that's a really difficult question. So the main funding sources for that fund is fuel tax. And fuel tax is really based on how many gallons of fuel are being used in Washington State, and then they get distributed on a per capita basis. And that's all to say that is not a growing source of revenue. Cars are getting better gas mileage. We're shifting to electric vehicles, so that's likely to stay steady at best and maybe even decline into the future. The other significant source is, of course, real estate excise tax, as we've been discussing, and that's really dependent on the health of the real estate market. Lacey we're approaching build out. So, in the long term, that's probably going to be a declining source of revenue. But we do, that is the identified source of repayment for the proposed debt for the police station. And, 15 million is right around $1.5 million per year. Historically, if you look at a 30-year average, we're, just over $2 million per year in real estate excise tax. We've had very strong years here recently. I mean, in the $4 million per year in terms of those collections. But again, that's really cyclical in nature and really is going to depend on, what the real estate market looks like in Lacey. But, we do feel confident we'll meet that debt service commitment. But, we do need to be aware that whatever we collect in excess will be the limited funds used for street improvement projects. So it's all to say there's a fine balance there in terms of what we're looking at in the future.
And I guess that does lead to the next logical question is, what does this do to our capital improvement plan when it comes to our arterial streets, since we are taking away the major funding of our arterial streets? Are we just going to try to count on more grants and other sources of revenue to maintain our streets in Lacey? Or we have the transportation, our improvement district, but that is specifically for maintenance. That, and obviously, our arterial street fund covers a lot more than that.
Yeah, and that has been the approach, is to look very strongly at grants, and my hat's off to the transportation team here at Lacey. I think their record in attaining grants is unmatched. So, certainly we'll continue that effort. And that's, part of the reason why we have been able to build up this reserve is just the success of, our grant writers that go out and get that money for us. So that's, like I said, that's a large reason why we've been able to build up that reserve.
Okay, well, I look forward to having a more in-depth discussion of our reserves in next month. I think there's a lot of discussion I think we need to have, especially when it comes around our social service division with the police department. That's something that we've obviously seen some success with in Lacey. It's been very successful. I'd like to see that continue to grow, and we have more instances where we're sending people that are more maybe qualified to handle mental health crises or other things, and instead of a police officer every single time. That's, I think Lacey is sort of leading in that, and I think we need to continue to invest in those resources. And so I look forward to having that conversation on how we do that going forward. I see that the committed number in our reserves is going down for 2022. I need some explanation around why that is. But we can have that conversation next month with the full council.
That's great.
Anything else to do, Deputy Mayor?
No, I'm good.
And then let's go to our Social Security coverage.
Okay, thank you again, Mr. Mayor. I have two opening statements here because this is a bit of a shocking development. The first and most important, and I should say this several times throughout this presentation, but do you want to say throughout this period, there will not be any impact to any employee, current, past, or future in terms of Social Security coverage or benefits. The second thing I want to say is I normally, my core values are all about accountability and ownership, but I would like to say this happened before I was born, and it's been a long time since I've been able to say that. So I definitely want to get that on the record. I think the short story here is we had an administrative error that occurred in 1967. So right after the City of Lacey incorporated in December of 1966, we were, of course, as a city setting up benefits and that sort of thing in order to run our great city. And when we look at Social Security, this is really when it was intended as a safety net. This goes way back to the 1930s, and I think there was a major revision in the 1950s. So the general rule is employees that are currently covered by a pension plan are not eligible for Social Security. So that's a really important fact in terms of what happened back in 1967.
Can you repeat that?
So in short, the employees that are covered by a pension plan are not eligible for Social Security. And that is at the time that an organization joins Social Security. What happens after that doesn't really matter. And that's, like I said, that's at the real core of what's happened here. So back in 1967, the City of Lacey joined PERS, so the Public Employees Retirement System with the state, and signed off on an agreement with the state of Washington to receive Social Security benefits on the same day, March 1st, 1967. The Social Security Administration has ruled that really the situation is employees at that moment were members of our pension retirement system, so therefore not eligible for Social Security. Clearly, it was our intent, if you look back at all the ordinance that was passed by the city council, you look at the agreements that were signed at the time, it's pretty clear in my mind that the city's intent was to join Social Security before joining the PERS retirement system. So the fix is relatively simple. The council just needs to adopt a resolution stating that it intends to join Social Security on February 28th, 1967, not March 1st, so 1 day difference. So if the council does approve that resolution, that will allow staff administratively to start working on the correction with both the state and the Social Security Administration. That will likely take a number of months, take us well into 2023. But again, that will have no impact on employees' eligibility for Social Security during this period, as long as we make that correction. That will involve authorizing the city manager to sign a new agreement with the state, again, with that February 28th date. In the future, once we get that approval through the state, get that approval through the Social Security Administration, we will have to come back to the council for a housekeeping change within the LMC. The council back in 1967 adopted an ordinance. So all of this is in the LMC. Well, once we get that, all that approved, we'll have to go back and correct our LMC because it also refers to the March 1st, 1967 date. So we'll sometime in the future, we'll come back to council and have you consider an ordinance that will change that date by 1 day as well. So this is all to say this is really a housekeeping change, but it certainly set some alarms off when I first heard of this, but relatively simple correction. We would like this committee to move this resolution forward to the full council.
So can you explain how we caught this? I mean, are we currently not, our employees currently haven't been collecting, been charged Social Security, or it just our ordinance hasn't matched up with our practice?
That's correct. So we have collected Social Security from, the employees' paychecks. The city, of course, has an equal match. We've been collecting that and paying that into Social Security since day one, back in March 1967. We've had employees retire and receive those benefits. So in practice, we have been acting as a Social Security, member, and that's not going to change. Like I said, this really boils down to a housekeeping change that we need to make.
And how did you catch this? So what's the difference? I mean, I see the ordinance saying on March 1st, 1967, it'll take effect. Why are we having to go back and change that?
This was caught actually by the Washington State Social Security coordinator. I'm not sure what triggered this person to look at it, but it was discovered at the state level. This person was able to contact the Social Security Administration to confirm what she thought happened, or what the net impact of that was. But I'm not sure why it was being looked at. It might have just been kind of a random audit. It really is an odd situation. There was a couple different instances that somebody should have caught this. Not sure why. I suppose that's not important. I think what's important is we fix it. But yeah, it wasn't anything that we did from a city perspective in terms of discovering this. It was discovered at the state.
So, Troy, are you saying, okay, so once we lift this off, that doesn't trigger a reexamination of the things that we've done so we lift it off and then we place it back a day without a whole lot of, scrutiny or reexamining who's received benefits and when and how and why and all that kind of crap?
That's correct. We change a date, we're pretty much done, and no harm, no foul.
Yeah. Okay. Well, I move that we forward this housekeeping amendment to the full council for consideration.
Second.
Is there any other discussion? All in favor of that motion, signify by saying aye. Aye.
Aye.
Any opposed? That motion carries. We'll move it back a day for the record. Okay. The next up is the third quarter financial report.
Great. Well, before I start, thank you for that support. We're looking very forward to making that correction. You do have the full details of the third quarter report. I'm not going to spend a lot of time since we've had lots of discussions throughout our budget process. But the third quarter really isn't any different than the mid-year report. We're seeing expenditures coming in or going out as intended. We do have about a $7.5 million increase to expenditures within our general fund. That's mainly due to the timing of our kind of annual transfers that happened earlier in 2022 than 2021. I will note that we had about a $967,000 increase to our labor costs. Really what's interesting there is, for the most part, we don't have any cost of living adjustments yet in 2022. So we do have 3 labor contracts that are not settled for 2022, which, begs the question, why do we have such a large increase to the cost of labor? And really what that is we're starting to fill vacant positions. We've had, upwards of 30 vacant positions throughout the pandemic period. So we're starting to really, catch up with that. We've had some additions to the labor force. We've added positions as well. So like I said, just about $967,000 increase there. If you look at some of the details within the departments of the general fund, a lot of one-time impacts in terms of variances. Some up, some down, mostly up. Like I said, that's the main reason for the $7.5 million increase to expenditures. But we did have a decrease, as an example, of about $1.7 million, and that related to the capital improvements that we made at the Veteran Services Hub, as well as the Veteran Affairs Outstation Center improvements. But for the most part, like I said, it's been transfers in terms of the expenditure side that's impacted the variance. When you look at revenues, and as you've seen with the 2023 projections, we are seeing tax collections continuing to be strong throughout the pandemic, whether that be property tax, sales tax, B&O tax, utility tax. I mean, we're seeing that continued strength in that and through the third quarter. What's really interesting, I think, in terms of those 4 areas is property tax. So we have through the third quarter, we've collected about $822,000 more than last year. The council authorized an addition or an increase to property tax, from new construction, from annexation, the 1% revenue limit of about $460,000. And I think when we get to the end of the year, that is going to be exactly where we end up, about $460,000 increase of property tax. But really, I think we have a timing difference in terms of what's happening. We had a lot of discussion about real estate excise tax. The strength of the real estate segment of our economy was strong through the first quarter, certainly. And generally what happens when you close on a property, the full either first half or second half property tax is paid at the closing of that transaction. So if a house sold in January, the full first half taxes get paid, and they get paid early versus waiting until May 31st when those are due. So I think we really have a timing difference in terms of that extra $350,000 of property tax collections so far.
So this is your theory. Is there a chance that we could be up 800,000 by the end of the year?
Yes and no. So we're not going to collect more than what was authorized. So the way property tax operates is we cannot collect more than the legal upward limit of that, which is set by the city council through accepting new construction annexation. So I think we were authorized to collect just over $8 million. So there's not a legal mechanism for us to collect more than $8 million. The other theory I have is we always have some percentage of delinquent property tax that's outstanding. Part of that could also be related to this increase. You know, as houses sell, again, if you have a property that's in delinquent status, that typically is required at closing to have that catch up. So there's also a possibility that some of those past property taxes are being caught up. So we may exceed that $8 million, but it's not going to be from current year collections.
Okay, but under property taxes, isn't the personal property taxes included in that? Right? And that's a number that isn't restricted by 1%. Right? Personal property taxes is based on the value of, right? And so we may be seeing, we've had a lot of construction that has happened that has increased personal property tax within that. And so we should be able to see an increase on that personal property tax side that goes over the 1%.
Well, we do set our levy rate based on the 1%, and we do that as a whole because that personal property valuation rolls into that same number. It's the same tax rate. Yeah, that's a really interesting question.
Yeah, I don't see how that's possible.
Yeah, I'll have to take a closer look at that, but
Isn't it folded into your assessed value of your
Yeah.
entire property?
I'm trying to envision the assessor's certified reports that they send, and there's 4 or 5 columns that go into our total assessed valuation. I'm pretty sure that personal property is included in that number. So in a sense, we self-restrict ourselves to that 1%, I guess is what I'm trying to say.
Trust me, my personal property tax is not limited at 1%. You know, for example, I had a major, well, not major, but a pretty decent renovation. And I bought new equipment, right? And so when that new equipment came in, I basically depreciated out all my prior equipment. And so when I got my personal property tax statement, you know, it went up significantly because it was brand new equipment compared to equipment that was put in 1985. So trust me, I'm paying a lot more in personal property tax this year than I did last year.
Right.
So I don't
Yeah,
know
I think your situation is probably more along the lines of new construction. So you're really a new taxpayer, so to speak, in terms of that equipment. So it's no different than a new building being built in Lacey. We add that valuation separate from the 1%. So it just becomes a new parcel. And I think your personal property is very similar to that. It's brand new tax base that gets added into our assessment, completely unrelated to that 1%.
Yeah, I think you need to check on that a little bit more because I don't know how. I don't see how that's possible, right? Because I do send to the assessor, you know, a personal property tax statement, and it changes from year to year, and usually if you don't do anything, it depreciates. You pay less personal property tax, but if you have, you know, new whatever, it can go the other way. And so I don't know how that's getting figured in to our assessed value.
Sure.
But-
Yeah. Let me certainly double check that and kind of follow the numbers through the assessor's numbers. And
Yeah, because there's no way that's limited to 1%. I wish that was limited to 1%, but that's not the case. There's no way it's the case. So,
right. Okay. Yeah. Give us a chance to look at that a little closer.
okay.
You know, throughout the general fund revenues, you know, we've talked about, you know, I think we've, for the most part, fully recovered in terms of the local economy. There are a couple areas, and it continued into the third quarter. The two areas that I would say I would consider not fully recovered are Parks and Recreation. We just haven't seen those same revenues come back, but we certainly expect them to. The other area is admissions tax within the city. That's just another area that we're watching pretty closely. It's just an industry that's I think as a whole hasn't fully recovered, and I think behaviors have changed in terms of how entertainment is consumed. I do have numbers in the report related to utilities. No surprises there. Expenditures and revenues coming in as expected. We do have some timing issues again related to the annual transfers. Again, they happened earlier in 2022 than it did 2021. So that's the bulk of the difference there. I won't spend a lot of time on the forecast and what we think the future holds for us because we've had a lot of discussions about that. But really, I think uncertainty is the word that comes to mind as we look at the outlook. A lot of different economic information out there and going in all kinds of different directions in terms of inflation, jobs, unemployment, production numbers. We do know that the Federal Reserve is intending to slow down the economy. They really doubled down on that statement here at the November meeting. Despite what happened to markets, if you looked at the stock market, if you looked at what's happening to investments, all going up, the Federal Reserve, I would say their reaction has been 1 month doesn't make a trend. So they are going to continue down that path of rate increases. There'll be one final meeting here in December, I think the early part of December. And the expectation is they're going to raise rates again December by 50 basis points or 0.5%. So again, they are continuing to try to slow down the economy. And, I think we've been mindful of that and certainly need to continue to be mindful as we look forward. So again, in summary, the third quarter, no surprises, everything pretty much happened as planned, but I'd be happy to answer any detailed questions you have about the third quarter report.
You have any questions?
I just had one quick one. The mobile outreach team, 124,825, was that number, did that number start at 90 something? When we first saw this, when we first visited this, and if it has gone up, that's great because they deserve to be paid, a little bit more. But some reason I thought that number started lower. I know it's not that big or critical a thing, but I saw that number and I thought we authorized somewhere in the ballpark of 90,000 for 2 people.
I thought the number was it was lower than this number, but I don't think it was quite that low. I want to say it was 120,000.
And they've added I'm escaping the name, like a peer response specialist or mental specialist as an added resource to the Mott team.
Mm-hmm. Well,
Where-
good.
where
I
you-
think we're doing a
Where are you
great job.
seeing that? Where are you seeing that, Deputy Mayor? In the
It looks like it's on page 2. Just past the second paragraph or first paragraph, first full paragraph, and then there's got 3 bullet points there, and it's the middle one.
Yeah, and we're I believe the proposed budget for 23 is 180,000. So I mean, we definitely added to that service. And I think we're exploring some funding, I think some federal funding potentially to help offset that, but I'm not sure what the status is on that, but yeah, this is definitely a growing area. Our commitment to social services continues to grow. So,
Well, the email traffic certainly has slowed down with regards to, what these guys do. So again, I think they're doing a great job. I was just curious about that number because I thought I remember, a lower number, but if we're adding to that department, no harm, no foul.
Well, yeah, and I hope that's something that we continue to discuss of how we can increase services on that side. So anyway, anything else third quarter? then let's go on to the last agenda item.
Okay, thank you again. Have a couple concepts to run by the committee, and this relates to our long-term investments. We were before this committee just recently talking about our strategy for the last quarter 2022 and into 2023. We have a bit of new information, so we'd like to come back and have a little bit of a discussion on a couple items, like I said. The first is we had a recalculation in our liquidity percentage. So we have a little more liquid funds than we originally thought. I will preface that with there's not additional money. It was just what we looked at in terms of short-term and long-term. So we would like to explore the idea of putting more money into long-term investments, somewhere in the $20 to $30 million range. To give you an idea, in terms of the difference in yield, currently the state investment pool, which is a very liquid investment. I mean, we could get our money out of that pool for the most part the next day. So it's no different than a bank account. That pool is earning, well, as of yesterday, it was earning about 3.8%. If we look at the longer term investments, it's in the 5% range, so about 1.2% higher. So for every $10 million of long-term investment in that yield difference, that's $120,000 per year. I do want to remind the committee that we have about, I think it's $57 million of long-term investments maturing throughout the next 12 months. So in terms of cash flow, don't see any challenges there. So again, we would like to take a look at getting some more yield out of our investments by shifting a little more liquid funds. We'd still be within that best practice range. I think we discussed of keeping liquid funds between 20 and 35% of your total fund balance. So this would get us kind of towards that lower end, probably that 21, 22% range, but again, still within that recommended range to try to get a little more investment income coming into the city. I don't know exactly what that looks like in terms of timing. We asked our investment advisor to put together a proposal for us to consider. We do have, like I said, the Federal Reserve is meeting here at the beginning of December. I personally don't know what the impacts might be to the market. So we certainly want to get their recommendation in terms of that. So really the question for the committee is, are you comfortable in shifting more liquid funds to that longer term investment look to get a little more yield for the city?
So how much longer? What are you thinking? You're into a 3 to 5 years?
Yeah, it's probably in that longer range. Our benchmark is 0 to 5 years, but you're probably remembering that we're a little front loaded because we just recently shifted from that 0 to 3 to 0 to 5. So we haven't had a lot of investments go into that longer term, but probably that's correct between that 3 and 5 year look. But we'll look at our entire portfolio in terms of how we ladder that. What's really interesting right now is we do have inverted investment curves, or bond curves. We've talked a lot about that in terms of being an indicator of potential recessions in the next 12 to 18 months. The highest yield right now is in that 1 year range because of that inverted curve. So we may look at that as well, but I think you're probably right, Mayor. It's probably in that longer term, 3 year plus.
Well, my only concern in all of this is here we are at the beginning of this discussion of our reserves and where we pull from our reserves. At the same time, we are going to go out for a bond measure, and so it just feels a little weird. Like we're going to go out and ask. We have so much liquidity. We have so much in reserves. I don't know, it feels a little, little strange that we're not using those reserves for a need that we have on hand, but instead going out for a bond measure. I guess this is just reminds us more of why, thank goodness we're going this direction and not going out for a property tax increase, because that is a seriously hard sell when we're thinking, oh, let's throw more of our reserves into higher yield. Again, I'm really comfortable with what your direction on this, Troy. I mean, if you feel like we're going to be okay with wrapping up, our reserves dollars into longer term yields, then you have my trust and faith, and that's the way we should go. So, Malcolm, do you have anything you want to add?
No, not right now.
Well, I appreciate that, and to, maybe comfort you a little bit more. I had the same exact thought, Mayor, and to give you some comfort, the liquid, when you look at, that 20 to 35% kind of target area for liquid funds, I mean, that's still in the $35 to $40 million range. So we'll still have a significant amount of liquid funds still available. And again, we'll have somewhere in the neighborhood of 57 million maturing in the next 12 months. So we can make our decisions based on, council priorities and where we're at in terms of capital projects and whether we need to keep that as cash or, invest longer term again. So we'll have plenty of opportunity to make sure we have liquid funds available for whatever our needs are.
So that 57 million that's currently invested, how does that show up on our books? Does it show up as a committed reserve, or how are we showing that number in our budget?
We pool for reporting purposes and interest distribution. So we have 29 different funds, and say 29, different separate pots of money, so to speak. So we pool the entire 29 funds together, and then we distribute interest in those balances, kind of on a per capita basis. So depending on what the cash balances in those funds, they get distributed out. So it's an easier way from an accounting perspective for us to account for that. So can't quite answer your question. We don't have those funds identified exactly on our financial statements versus it's invested. So it's collectively treated as a whole and then reported. So I can't answer your question, so to speak.
So I think the quick answer though, Mayor, it's not in the budget, nor is it in the reserves.
That's where I was coming from too. It's like we don't ever see that number in our budget, right? I mean, we have no idea. We just heard it. So we have 57 million that is going to be maturing this next year. How much do we have total out there?
220 million.
220 million. That doesn't currently show up in our budget anywhere.
Right. And the reason we do that or don't do that is to budget for reserves, you end up with a beginning and an ending balance, and it inflates the budget by 220 million.
Yeah.
I mean, we certainly could. I mean, that's really a philosophical approach to the budget. Some cities absolutely do budget for their reserves, but it ends up being, like I said, a revenue and expenditure that is available.
Sure. But this is always something that I've been trying to wrap my head around, because we talk about reserves, committed reserves, assigned reserves, but we never talk about how much we actually have that are currently in an investment. Really that number, that 220 million, that's something we just don't really talk about because it's not in our budget.
But you do see that, Mayor, when we come back with our quarterly reports and show you what our investment portfolio is. I mean, that's the number, then what you're seeing in total what we're investing.
Sure. But I thought, I thought that was somehow captured within our budget somewhere, but it's not. It's a separate report. And I bet you that this council has no idea either. So anyway, I'm just saying, we talk a lot about reserves, but we don't talk about that number that we have, because it's not part of our budget process. We never, I mean, so anyway, just putting it out there.
The second piece here really quickly is another idea is to take some of our liquid funds that we know we're not going to spend within a year and shift those into the longer term as well, but within that 1 year period. I probably feel a little less confident about that just from, again, Mayor, your statements about, well, do we lock up this money? And but did want to kind of gauge the council's comfort level with that. Again, the real sweet spot in the investment market right now is in that 1 year range. In fact, I want to say it's 5.2% yesterday was kind of the average yield. So we could pick up nearly 1.5% in that period. So and we haven't really done an analysis in terms of that cash flow in terms of what is needed for 2023, but did want to kind of keep that as an option if we could gain some more yield for a 1 year period, that we could do that. But again, we don't quite have a full understanding of cash flow, and we probably kind of need to get a little more comfortable with that, but did want to gauge the comfort level of the committee for that kind of concept as well.
Well, that makes a lot of sense. The one that short, I have no problem with a short, higher yield 1 year return. I mean, I say go for it on that. It's just there's so many moving parts right now on the other things that I feel a little less confident wrapping those up for 5 years. It just, there seems like to be a lot of question marks out there. So, but again, I think let's wait to see what the company investors propose, and we'll go from there. Okay, do you have anything, Deputy Mayor?
No, I'm good.
Well, with that, we've reached the end of our agenda. So without objection, I will call this Finance and Economic Development